Hello and welcome to Views from the Top. I'm Sarah Allen and today I'm joined by Alex Ventelon. Alex is the Head of Research and Investment Strategy for Morgan Stanley Wealth Management Australia. Today we're going to be discussing some of the big issues in markets and how Morgan Stanley are positioning for these. Alex, welcome.
Thank you, Sarah.
So to begin with, where are we sitting in the market cycle?
Well, Sarah, look, it's been a very unusual cycle. We do think right now that we are in the downturn phase in the cycle, which is where most macro data are at a stage where they are below average and falling. And that usually is the time that precedes a recession. However, this time around, this has just led into a slowdown of the global economy in the US, in Europe, and in Australia as well. But we don't think this is going to end up in a recession. We actually think it's going to be a soft landing. So this cycle could very well see a bit of a pattern like what we had in the mid-90s, around 94, 95, where the Fed had to increase interest rates in response to the strong economic activity post the early 90s recession. But then the Fed saw the need to cut interest rates mid-cycle as well. And I think that's where we are heading right now. So once again, we are in the downturn phase, but some indicators like the PMI, Purchasing Manager Index on the manufacturing side in the US have started to turn around. And we could be, getting out of this downturn phase in the month ahead of us and going back into expansion, so which is very unusual, but that would coincide with the soft landing scenario, which is the scenario we have for the global economy and the US most importantly.
Does this also mean Australia is likely to escape a recession? Yeah,
well, look, we do think so. Clearly, Australia has a lagged cycle versus the rest of the world. Our inflation here spiked up a few months after the US or Europe. And same, we started hiking interest rates after the main developed market peers. We think it's going to be probably about the same here in terms of inflation falling a bit later and the interest rate cutting cycle. From a macro standpoint, look, the economy has been quite resilient. We are seeing the sign that the economy is cooling, though, across a number of levels. But clearly, the big offsets we've had in the economy have been migration, which has been running, like 2%. 2.5% even population growth last year. So very impressive. Should cool down to about 1.8% this year, but still be well above the pre-COVID trend. So it's going to be a massive support for the economy. And also, very importantly, what's going to bail us out from a recession induced by higher interest rates is really the fact that we see this year as being a year of fiscal support in Australia, which is something we've seen a lot of in the US with the CHIPS Act, the IRA, etc. In Australia, it's going to be mostly due to the tax cuts. We are seeing the stage 3 tax cuts probably pushing about 20 billion into the economy. And in addition to that, we are also seeing about 3 billion worth of more fiscal impulse at the next budget. So all in all, it should be a bit less than 1% of GDP going into the economy from fiscal impulse this year, all backloaded into the second half of the year. So even if the economy decelerates, even if the economy actually contracted in the last quarter of the year on a per capita basis because of the migration, we don't think we're going to get a recession in Australia, and we think it's going to be a soft landing here as well.
What does this all mean for the chance of a rate cut in Australia this year?
As I mentioned, we think that the Australian economy right now is cooling, but it's cooling at a very gradual level. So there is no need for now for the central banker to intervene aggressively. Remember, our inflation rate is still around 3 to 3.5%, depending on which measure you're looking at. So it's still a bit too hot to be cutting interest rates right now. Also, the last job numbers were quite steady in Australia. So if you're looking at the sort of central bankers' metrics of indicators, it's too early to be cutting. In addition to that, as I said, we have this fiscal spending that's going to be announced probably around the budget, then the tax cut. So it means that in the second half of the year, we will see a very strong fiscal impulse. We are also expecting the consumer to be spending about 60% of the tax cuts they will be getting in Australia. So we will see a difference, right, in the second half of the year. Also, mid-year, we are thinking that the ECB, the European Central Bank, the Bank of England, and the Federal Reserve in the US will all be cutting interest rates in June, right? So for the RBA as well, I think it will be important for them to see how the rate cuts are going in the rest of the developed markets and what impact they have on the economy and the inflation backdrop, but also take their time to look at the real impact of all this fiscal impulse into the economy in the second half of the year, right? Noting that inflation has been, the inflation moderation has been trailing a bit behind the other regions in the world, because once again, our cycle is lagged. Putting all that together makes a case where we don't think that growth and inflation will be cool enough in the second half of the year for the RBA to be cutting interest rates. So if it happens, it's really going to be at the back end of the year, and more probably in our base case, we are actually of the view that the RBA will start cutting in February of 2025. So about 8 months behind the other major central banks.
What are the key risks you're seeing across global markets?
There's a number of them. As you would know, I think it's clearly a year ago or 18 months ago, we were a lot more concerned about the shape of the global economy. We had, the US central bank hiking interest rates by 5% in less than 18 months. So an enormous amount of interest rate and monetary tightening to digest in a short period of time. And historically, when you look at the inversion of the yield curve it created, the fall in the leading indicators that it induced as well, clearly the sort of heat map, the recession heat map, was flashing orange to red. So we haven't had that, and a lot of that has been offset by, in the US, the fiscal spending. As I mentioned earlier, a number of the plans looking at transforming the US economy have led to the US economy last year running a deficit of about 6.5% of GDP, which is really enormous, right? So that's a very expansionary budget. It's not the sort of budget you're running so late in the cycle when you're trying to cool down the economy. So if you look at the old model, where you're late cycle and there's all this monetary tightening coming, you would have expected a recession is coming. But because there was the fiscal offset, the recession didn't come, and we think that, although soft landing remains the base case, in the background, some things have been damaged, right? We see the consumer activity being a bit more sloppy, I would say, if we can say so. I mean, clearly the consumer is not in as good a shape as it was 2 years ago. We are seeing credit card debt balance going up in the US. We also have seen a rise in default in terms of corporate credit in the corporate sector in the US. So we need to keep an eye on that. We need to keep an eye also on the US commercial real estate market. There's about $2 trillion of debt that was due to be refinanced up to December of 2025. So still in the background, there are a number of major players in this market that will seek refinancing at much higher rate than before. And for a lot of them, especially in the office space, we are seeing that it's a very tough environment where valuations have gone down, rents are going down as well because vacancies are at 20-year high, right? So that's a major risk we need to monitor. The major source of funding for the commercial real estate in the US was the regional banks. And as you've heard, in the last 12 odd months, a number of them have gone bankrupt, right? So the Fed has been supporting, providing, funding facilities in the background, but we know it's been sort of well talked about that there will likely be more defaults in the space. in the broader sort of commercial property space, there will be more tension. We don't think it's a systemic risk, a GFC type sort of risk, but we think it's a risk, and there could be some more damage into the banking sector, especially in the smaller capitalization sector in the US. So these are the sort of risks that we are looking into for the medium term. I would say in the shorter term, of course, we can talk about the fact that valuations have gone pretty hard. You know, the US equities trading nearly 21 times. When we look on a risk premium basis versus bond yields, we are close to zero in terms of earnings yield versus bond yield. The earnings expectations are pretty punchy as well, so it's going to be hard for the average company, you know, to match these expectations in a context where both growth and inflation are going down, and the markets run pretty hard. So are there chances of a tactical pullback given the very strong rise in markets, you know, up nearly 25% for global equities from the bottom in October? Yes, I would say there are some chances of, you know, mild pullback that might have begun a couple of weeks ago. But we are not of the view right now that there is a sort of a major risk of a sort of end of cycle collapse in the equity market, but we are monitoring all the risks I mentioned.
Turning now to the opportunities, what opportunities are you monitoring at the moment?
What is interesting is that once again, we are in an environment where both growth and inflation will be slowing in the first half of the year. Knowing that companies' earnings are nominal, this will create downside pressure on companies' earnings, at least for the average company. So we are not that bullish on the outlook for the average company in the next 12 months. Where we are bullish is in the outlook for companies that benefit from secular tailwinds, which are already paying off now. AI, edge AI, so artificial intelligence, software, and sort of within the device also space. We also see a very compelling environment in healthcare. There are sub-segments of healthcare where there's genuine revolutions that are happening right now. We can talk about weight loss drugs. We can talk about the rise of smart chemo as well. So these are things that are transformational. And what we're looking at is areas where the companies cannot cut the expenses. And, you know, talking about IT spending, AI is one thing. The other thing is cybersecurity. We've seen that at length across a number of countries. We've seen that in Australia. We've seen that in the US lately as well. Cyber security attacks, in terms of the numbers and the scale, they are on the rise. So corporations don't have the choice. They need to spend more, and even governments, they need to spend more into the space. So the players, the sort of leaders in the field will continue to see their revenue side grow because of that. So these are the sort of key thematics that we like around the equity spectrum. That's more from a sector standpoint. From a country standpoint, I think we also have, you know, transformations happening right now in Japan. So we've been bullish on Japan for more than 2 years now, as we saw the impact of the Abenomics really kicking into the economy, and also all the reforms around the governance of corporations in Japan, leading to more shareholder-friendly policies, getting to better profitability, and eventually transforming into higher valuation for Japanese stocks. And we think that that's a multi-year thematic that has started to play out very nicely, but there's more ahead of us. And the last one is clearly India, where we see the reforms as well driving the country, the population growth being also a major driver, the need for infrastructure, the need for more industrial development in a country where the services sector is actually quite well developed already, and we see further growth, India will be the third largest economy by 2027, and this will be on the back of very strong real GDP growth of around 6% and inflation around 6%. So 12% nominal growth will compound to make it an even bigger economy than what it is right now. And this will feed into higher returns into the stock market as well.
How are you positioning your portfolios to take advantage of the short and long-term risks and opportunities you see?
The way we are positioned right now is really very well aligned with all these thematics we talked about. We are trying to capture these opportunities. A lot of them actually are grouped into what we call the quality factor in the US. So they will be captured by companies that have a more stronger profitability, more consistent earnings, and also very often cleaner balance sheet. And so, the players that we like within the Magnificent Seven, a lot of them lie in this quality bucket. A number of key players also in the thematics that we discussed, AI, pharma, etc., also belong to this quality bucket. So quality has been a great thing. There's a number of funds or ETF that help us get exposure to that, to get exposure to these businesses that have this sort of secular competitive advantage as well. We find though that a lot of these opportunities will be more present in global indices than Australia, right? So that's why we've had this overweight to international equities versus Australia, and we will continue probably to run that overweight international versus domestic as long as we see the signs of that sort of a quality bucket outperforming. So that's where we're looking at. We don't think that the time is just right now to be going into more sort of cyclical thematic. We need to see bond yields come down and really PMIs turning up a lot more forcefully, I would say, or leading indicators to really bottom out more forcefully for us to be more positive on small caps and very discretionary and cyclical stocks. We think that's for a bit later in the year, probably. So happy to stick with quality. Japan is a key overweight to us. We are seeing green shoots in Europe as well. We're getting in there a bit more progressively, gradually, and for the most risk-on investors, I think, as I said, India is a good multi-year thematic, and admittedly valuations a bit stretched, so hard to get into right now, but clearly it's a market that we are looking at in terms of sort of averaging in through the years. That's for the equity bucket. We are no more than neutral for the risks I mentioned earlier. That is that the markets run pretty hard already and we're probably a bit vulnerable to a temporary pullback. We are no less than neutral either, because we think that the soft landing and the rate cuts will push the markets higher in the next 1 to 2 years. In that backdrop, it's good to hold bonds to get, to benefit from the higher yields. Also, if we were to get a recession, that's where government bonds would really help to balance the portfolio. But we have been very positive on credit for a while. It's paid off very nicely. I think in Australia, in the floating rate space, there's plenty of opportunities because our cash rate is likely to not move this year. So you get a good carry out of that. And most of the paper issued on floating rate within sub-debt, hybrids, or floating rate note is of good quality. And in the alternative space as well, we find opportunities in private debt, in private equity on the secondary market, as well as hedge funds who benefit from the current sort of, or what we expect to be a bit of a more volatile market with higher interest rates.
So finally, what's one thing that you've become privy to recently that you wouldn't have known or had access to had it not been for your position today? What's your view from the top?
In terms of managing a team of investment professionals, I think it's, I would say, there's two things that matter the most is the process and the team, right? And I don't think that, Warren Buffett said that much better than I did, but I don't think you need to be that smart to be a good investment manager, but you need to be paying attention, you need to do the homework. And for us, it's really doing a lot of work around the process and having the right people in the team and the right attitude. And I think that really creates a culture of performance and collaboration that is paramount. The other thing, as I said, is the process. I think in my 18 years in finance, I've found that things are a lot more systematic than we expect them to over the long run. And very often the same cause leads to the same consequence. So it's worth trying to find repeatability and consistency in terms of finding a good investment idea and building a process around that. It's also very important to be humble and know that no process is entirely bulletproof, and it's also important to know that when will the process not work. So that's when you take over as a manager, but most of the time the process that you've spent time developing will work. So you have to trust the process that you develop, you have to challenge it, but if there's no real reason to challenge it, you have to trust it, because very often a good process delivers phenomenal value over the long run. So I would say the process and the people.
Thank you for sharing your insights today.
Thank you, Sarah.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.